Good day, my viewers, and welcome once again to this channel, Accounts and Business with Abiola. We'll be rounding off our topic, depreciation and disposal, with this class. We did methods of depreciation, causes of depreciation in class 1, and in class 2, we did schedule and preparation of depreciation using straight line method. And in class 3 of this topic, we did presentation and a schedule of depreciation using reducing balance method. Today that we'll be rounding it off. We'll briefly talk on the revaluation method and the disposal of assets account. For revaluation method, it's quite used most times for loose tools. Assets are many, so many of them perhaps in the business, and they have sometimes small values, but they last more than a year. So you look at them, external evaluators or experts will tell the business of the value at the beginning of the period, and at the end of the period, external experts or evaluators will show the value, their worth. The difference between their opening value and the closing value is the depreciation for that year. That is how to do depreciation using revaluation method. However, if new assets like the loose tools were brought in during the year, it will be opening value or revaluation. It will be opening value. If there were additions to the loose tools or to the assets during the year, it will be added to purchases of assets, that same asset. If there were disposal during the year, we deduct. Then we deduct the closing value. That is how to get depreciation using revaluation method. It's that easy. The issue with revaluation is just that you need experts, financial experts or external evaluators, to show the values or the worth of the asset at the beginning and at the end. Finally, on this topic, we'll show how disposal accounts is prepared. Disposal account is like accounts prepared for the sale of assets that the firm had finished using, in quote, that has reached their expiration with the business, or the business wants to change them for a better asset, or the business does not just have use of these assets again. These assets most times are disposed. Now, in the left side, the debit side of disposal account, the cost of that asset you are disposing, that's the amount it was purchased for, or purchase cost, will be shown. So in this case, we are dealing with machinery account, the value in dollars, the cost of this asset. Don't forget, when we are disposing asset account, machinery, it must be credited to the asset account, because the asset is no more in existence when the business disposes it off. So it has to be credited to machinery and debited to disposal account. Now, in the credit side of disposal account, the aggregate depreciation will be shown. That's the total value altogether that you have used on the asset. So provision for depreciation account will be credited. That's the aggregate depreciation that has been used all together on the assets. Then in the credit side again will be the amount the asset was sold for or exchanged for. Sometimes the business may exchange an old asset for new asset, or the business might just sell it off outright. If whichever of the two, the sales proceed will be recorded here. So if it is on cash or on credit, the person that it was so the sales proceed obtained from the asset, or it will be exchanged sometimes, will be recorded in the credit side there. Now, these are the benefits obtained from the asset. This is the cost obtained incurred on the asset. Benefit is the provision for depreciation. That's what you used total of what you used from the asset. And this is amount you still sold the remnant in quote for. So this is benefit, this is cost of the asset. So if benefit is more than cost, that means you have the difference here, which is profit on disposal. This goes to income statement as an additional income. It is added to the gross profit. However, if the cost of the asset you are disposing is more than the addition of this, that means cost is more than benefit, that means there is loss on disposal, which is written in the expenses section of the income statement, and you close your accounts like this. So recap: disposal account shows is prepared whenever an asset is being disposed, is being sold off, or is no more put to use. Debit side is the cost of the machinery at the point of purchase. Credit side is the total depreciation used on the asset and the amount of cash you got as proceed on it. The difference will either be profit on disposal or loss on disposal, which is recorded as additional income or an expense respectively in the income statement. This will be all on this topic: depreciation and disposal of assets. Thank you and see you again next time. Bye. Wow.